Hey guys, welcome all of you new and established content creators, entrepreneurs out there. Welcome to our new series called More Money, More Problems. Now it's gonna be a three-part series that'll go in depth into all the pain points and various headaches that content creators are facing out there. And hopefully we can offer some very powerful solutions that'll be able to solve some of these financial worries and tax issues you guys are facing out there, and make sure you don't, make the same mistakes we have seen so many of our clients and potential clients have made in the past. So first, I just want to give a quick introduction of myself. My name is Alan Chen. I'm a CPA and founder of Free Cash Flow Agency, an online accounting and tax compliance agency started with one audience in mind: the online business owners. So be that you are in the content creation space, SaaS, startup, or e-commerce, we're here to serve you and make sure you maximize your tax savings. Now, my lovely and good-looking collaborators over here on this series over here is from Bromley Helena Wealth Advisors. Do you guys mind introducing yourself to our watchers today?
Of course. Thank you, Alan. Happy to be here. Bromley and I run a wealth management firm, also serving clients who are content creators, online businesses, and small businesses who are entrepreneurial in spirit. That's our sweet spot.
Awesome. Bromley?
Yeah, happy to be here. Thanks again for the platform, Alan. Yeah, in general, we love helping people compound their wealth, automate it, and let it happen in the background so you can focus on your passion.
Awesome. So just give you guys out there a little content while we did this. We have seen so many clients and potential clients make these very simple, sometimes financial mistakes that really compound into the future. And we want you out there to avoid these things. So hopefully by watching this series, you guys can do just that and have a great and amazing financial future out there for you. So with that, we're going to jump into it. We're going to try 3 different formats with a new series we're starting. First, a Zoom call, just like the one we're on right now. Then an IG Live, and then even an in-person showdown to make sure you guys get all the delicious knowledge that we're going to impart on these episodes. So if you guys are ready, let's get this kick us off. So 3 topics we're going to talk about are tax-efficient investment strategies, record keeping for content creators, and financial mistakes to avoid. We're going to give you some juicy stories at the end to end this all. And then you guys are going to hear about what things you guys should avoid so you guys don't have sleepless nights. Cool. So let's kick it off. So first, topic number 1, tax-efficient investment strategies. Now, I'm going to be really curious about this one because I know Bromley and Helena is going to be the expert over here. So why is it crucial for content creators to kind of optimize their financial management and wealth creation strategies out there?
Yeah, I think the first thing that we go into, especially as you start really spinning off a lot of income from your business as an influencer, right, is we've got to avoid taxes at all costs. And in general, if you understand, depending on how your business is being run, often that active income is taxed the harshest, right? If we can spin up money and get our money working for us in brokerage or advisory accounts through mutual fund or ETF or index strategies, in general, our money gets treated a lot better. The income that it's producing, also known as portfolio income. And there's different tax advantage accounts, or asset classes like real estate, heavily tax advantage. There's a whole world of life insurance, lots of tax advantages in there. There's different retirement type accounts, whether it's pre-tax or Roth, 401k, SEPs, simple IRAs, etc. So really just understanding where can we deploy dollars where it's going to be treated better. And most preferentially, we can either defer and then never pay taxes, right? Or get the taxes out of the way and never pay taxes on all the growth that happens within those accounts.
That is so powerful. And I think a lot of those things you mentioned, Bromley, people out there do not know exist, right? So even to have that basic knowledge that these kind of asset classes or tools are available is amazing. Helena, anything you want to add to that?
Yeah, I mean, at happy hours, we're not talking about how money is taxed more favorably than sweat. And that's what we think about, right? Like when you work and have an income, that's taxed differently than the portfolio that Bromley was referencing. We also know that as small business owners, we don't have that infrastructure in place the way that people with W-2 salaries typically do, where there's a 401k set up for them. There's a 401k match typically. There might be some Roth options for them that are kind of streamlined into the comp package as a W-2 employee. As a small business owner, content creator, influencer, you have to take the reins and create that for yourself. And we see that typically the earlier you start, the faster it can grow.
Compound interest, one of the most powerful things we have in life and nature, right? Yeah, and then I also want to touch on one of the things that Bronley mentioned, which is on the retirement side, right? So one of the most Google questions, I looked this up, one of the most Google questions is, what is an IRA and what is a 401k? Could you guys explain it like I'm 5 about how these things work so that, content creators out there listening right now can take advantage of them?
Yeah, so there are two separate sections of the tax code. So section 401k is typically what you get, if you register an account or you've got, a W-2. And the limits in there, if you're under 50, you can personally contribute up to 22,500 for the 2023 tax year. And your company is allowed to put in a certain amount on your behalf as a match or profit sharing. Once you're 50 or older, you could put up to 30,000 into that account. So the government allows you to kind of stretch the muscle there. And there are 401k, section 401k, there are pre-tax options and there are also Roth options. So it gets very confusing because a completely different section of the tax code is section 7702. And that's where the Roth IRA lives and has completely different set of rules and different governing bodies, quite frankly, that are overseeing it. And so with a Roth IRA as an example, the limit under 50 is 6,500 for the 2023 tax year. It's known as an individual retirement account. That's what IRA stands for. So typically not for, if your company is a group, like, an IRA wouldn't be suitable. Once we're 50 or older, we can put up, $7,500. So in general, if we're making a lot of money and have good capacity to invest, we're very limited within the Roth IRA space. And in addition, there's also income phase out limitations that we got to adhere to. So high level, those are a couple of the big differences in scope of what you can put in, different tax codes, and there's some, small rule changes between the two. But the bigger vehicle is definitely the 401k. And it's regulated by the Department of Labor, and there's safe harbor rules. And in general, there's a lot more complexity. We'll typically use a third-party administrator to do a lot of the registration that needs to happen on the back end.
Got it. That was great. Very insightful, Bromley. And these are things that are literally set up by the US government to help you save on your taxes, but at the same time allows you to put money away for your retirement, right? No one want to work at their current job forever. People want to go to the Bahamas, enjoy their life. And this allows them to do that, right? Because this money is what going to grow tax-free so that when you're ready to take it out, when you're ready to enjoy your retirement, you're able to do that. Helena, have you heard any interesting stories on the client side about how they took advantage of these 401k or IRA or different retirement plans to make sure they enjoy that financial freedom later on?
Yeah, I think to synthesize, 401k is pre-tax. Typically you deduct your contribution. Roth is post-tax, so you pay tax on it now, and then you the money grows and compounds tax-free until distribution. For both of them, we can't touch them without penalty until you're 59 and a half. Required minimum distributions are required for the 401ks because the government says, hey, we need this money to be taxed at some point during your lifetime. So we're going to make you distribute it and create that drip. Client stories, I think that there's just a lot of confusion and ambiguity around like, what do I have? What's out there? Should I reset my password? I got this email or this letter in the mail, but I don't work at the company anymore. Or there's just not a great way to organize all of those accounts. The government doesn't create like a simplified, like, oh, Alan Shen has all of these existing retirement accounts from all these previous employers, and this is how they're performing. And This is, you know, the fees associated with their investment management. So that's what we encourage our clients to do, is to reset your password, collect all the data that's in the statements, and then think through, hey, how do we want to spend this? It's not a very interesting client story, but we see these accounts sitting in cash so often. I mean, it's exciting for us as investors, because we can certainly move the needle.
401k.com.
Okay, go from 0% to a higher percent, right? It's like, look at that, triple your money day one.
Yeah, so I guess that is pretty exciting.
No, that's great, and I think that's something that, you know, people should keep in mind, right? Because there's those folks that are very hesitant about getting started on investment because they think they'll lose their money, right? Because they don't know what they're doing out there. Or it's the other side who, you know, just listen on social media or TikTok and say, you should invest in this and this and this and this, and they literally just put their money in everything: cryptocurrency, some artwork, some this, some that, and again, all types of trouble for their tax situation. They're not tax efficient, and they may even owe a bunch of money they don't even know about, right? Because they have, like Helena was saying, 10 different accounts, you know, set up everywhere. They're not consolidated. They don't know how much fees they're paying for all these things. So they could be paying out their, excuse my language, out their butt, right, for all these fees, and actually losing money if you actually include all those things. So let me throw a little scenario out for you guys, so then it'll be more, I would say, relatable for the watchers out there. So say a content creator comes to you guys, says, hey, I'm killing it right now. You know, I use that work a W-2 job. Ever since I started doing streaming or some sort of content creation online, I'm making 200K a year, you know, pure 1099 income. And I think this number is going to increase, I'll say like 30 to 50K for the next few years, right? And my plan is I want to retire when I'm 35, right? I'm 23, 24 right now. I want to be in the industry for 11 years, make a boatload of money, and then be able to take care of my parents, take care of myself, and live off this money, right? Am I able to do that? What can I do in the next 10, 11 years to prepare myself to make my goal or my dream come true, right? What would you guys say to this person?
Don't spend all of it.
Don't spend it all in one place.
That's great, number one. Yeah.
It's a great scenario, Alan, because you got to start to be creative. Traditionally, 401k retirement accounts, right? A qualified retirement account, 401k, IRA, whether it's pre-tax or Roth, they're all earmarked for 59 and a half, right? So they're not great vehicles to get to grow and compound wealth and then get our money out at 35 to 59 and a half. Because to pull our money out, there are tax consequences on every dollar we put in there, every dollar of growth if it's pre-tax, and then a 10% early withdrawal penalty, right?
Yes.
Which is going the wrong direction from a tax perspective. So when somebody's looking to retire early and we want pools of capital to bridge that gap, now think of building a bridge from 35 to 59 and a half. Couple things we need to really put into consideration. Number one is, what are we doing for health insurance?
Great point.
Right? Health insurance is the number one reason why bankruptcy happens for the American population.
Medical debt.
Have medical, they go into a medical issue, they don't have insurance, they get into debt, it snowballs or spirals out of control. Absolutely. The second thing is, you know, brokerage accounts, right? Not earmarked for retirement, no special tax treatment outside of what we said at the beginning of, in general, long-term capital gains, we get taxed at 15 to 20%, depending on your income tax bracket. More efficient, no penalty to get our money out. So it's a great way to get our money working for us. Passive income investing through real estate, really efficient because we have paper losses that can offset our passive income. So if we build a real estate portfolio over that time period, we can have passive income where we're not liquidating portions of the asset to derive that, you know, financing for our lifestyle. That can be a great vehicle. And then the third one would be, again, not tied to any arbitrary age, would be like cash value life insurance is a third way where we can have money growing and compounding, but it's not tied to a specific, you know, future date when we can efficiently get the money. The only other strategy I would say is there is within the Roth IRA, if you've had an account open for 5 years, you can distribute out your cost basis without that early term penalty. Other than that, early retirement and traditional retirement accounts are kind of like oil and water.
No, that makes a lot of sense.
We do a fair bit of work within the FIRE community, financial independence, retire early, and we certainly, no pun intended, but we certainly respect the fire in their bellies to, do the work and then get out of corporate or get out of whatever work environment they're in earlier than 65. Our job as advisors is to dive a little bit deeper and to say, how much is life costing you per month now? Do we want your retirement or financial?
Do you want to keep your current lifestyle, right?
Exactly.
Or are you trying to go like a step lower when you're retiring, right?
Well, you're no longer generating revenue. So yeah, we would certainly encourage the ambition, but also be cognizant of numerically, how do we solve for that equation?
Yeah, for sure. So a little side question is, I know a lot of clients, when they come to me, they say, yeah, when I retire, I'm going to move to a third world country or just somewhere else where, it's cheaper to live. I don't want to be in LA anymore where everything's so super high expensive, where a burrito is like $15 now. So they say they move to like Thailand or Vietnam or something. What do you think about when they do that, when they become like an international nomad of sorts?
Yeah, it can be an effective strategy, especially when the dollar, right, to that currency is in your favor.
Right.
So we're creating some fiscal arbitrage, if you will. And then, yeah, I mean, I think in general, we just have to understand how can we patriate our dollars from one currency to another, what those tax ramifications are, and what decision making we have in the United States if a lot of our wealth is building and compounding here while we're overseas. There's a lot of rules, I guess, with, you might need a VPN to make trades and things like that while you're overseas.
Yeah, very good point.
So, like, say we're in the States, and I don't recommend anything that's not illegal, the record. But there are things that do need to be thought through. But in general, the digital nomad lifestyle, and even take a step back, we live in a high cost of living market, the three of us. A pretty common retirement approach is you buy a piece of property in California, 30 years pass, it's gone up 3-4x, the debt's paid off, you sell it, use your 121 exclusion for as best as you can, you take all that capital, you buy a house free and clear in Florida, and now we got all this capital to help fuel the rest of our life. So you see that, and I think the pandemic really sped that up, just with migration patterns in the United States, let alone, we go worldwide digital nomad.
Definitely. I mean, like you guys, we all know how expensive it is to live in California. So I hear always talks about, people moving to Kansas or Texas or some cheaper place in the state to live in, or just literally just like I'm packing my bags and, I'm moving to India or something just so I can afford to eat again, and not just eat rice and beans in the market. So that was very insightful and very interesting. So I'm sure there hopefully will spur a lot of questions down people's mind now they know about all these tools and, things that they can really look into as investment classes, protect their money, right? Don't keep it in cash. Cash, you face inflation and you don't want that, right? You just get less.
Keep a good amount. Have your emergency fund.
Yeah, have emergency fund, but past that, you want to make sure you're not keeping the rest, right, in all cash holdings.
Yeah, we would say, budgeting is probably the first step everybody should do. And for whatever reason, many folks feel that budgeting is a 4-letter word. If you don't like the word, call it a spending plan. But find a way to align how you want to allocate dollars on a monthly basis to be aligned with not only your business goals, like what do you need to reinvest in the business to build your platform to reach greater monetization, whatever that might look like, but ultimately your value system, right? Spend money where you get value, and slash religiously where you're not getting value, right? Or if you're paying for a subscription and you're not using it.
Absolutely. Great point, and a great segue to our second topic, which is record keeping for content creators, right? So I'll start it off, right? Because obviously on the accounting and tax side, this is an ongoing headache, right? When we get a client in, they show up with a notepad with some receipts that they have, or they show up with, I wrote down a couple of things this year, and I have some document over here, and we're like, so what is that chicken scratch that you have there? Is that something we can count as a, like, are you sure you paid this, or is this good memory? I know you haven't done this in a while. And worst of it is when they just throw a bunch of things at you and said, yeah, go figure this out. It's like, yeah, we're not magicians, we're also not psychics, we really can't tell unless you direct us, right? So record keeping has been a very big educational topic for us that we've been trying to, not even just on a client side, but just a general education for entrepreneurs out there. Keep good records, because it's going to kind of bite you, in the butt later on, especially for the tax filing side, especially if you need to, one day, hopefully, grow big enough to sell your company. If someone else comes in and want to buy you guys off, and they see that you have numbers everywhere, that means they're not going to trust your numbers, right? You say your revenue is this much, you say your operating expense this much, but you can't keep a good straight story. You can't show them any documentation. I'm sorry, I'm not going to close this deal. I'm not going to spend a 7-figure amount on buying your company if you can't keep a straight story. I know, like, bookkeeping is another word that they associate with being boring, right? But in the world we live in, but we keep trying to hone on how important that is, because just like keeping a personal budget, bookkeeping is basically budgeting for your business to make sure that all your numbers, all your records, all your coding is correct. Not only does that help with tax deductions and write-off and making sure you're accounting for everything and not giving more money to Uncle Sam than you have to, you're also helping yourself set yourself up so that, if you ever need a bank loan, if you ever need to sell your business, go do due diligence, if you ever need to bring in shareholders, investors, right? These are dream words for a lot of entrepreneurs out there. You're able to do that because you're set up. Neither you do this yourself, get a professional to help you with all this stuff. You want this all taken care of, all the record keeping, taken care of. So that's a little tidbit of, and kind of like a PSA from the accounting and tax world. But how have you guys seen record keeping? When clients come to you for, wealth advice, what have you guys tell them about this topic?
We see everything. Like, it's all over the map. People will send us like Google spreadsheets with like 40 tabs, that like really
wonderful, right?
challenging for us to synthesize. All the data's there, but it's hard to make sense of it. Other people like come with napkins, right? Like it's really, really diverse. I have a couple thoughts. I think if you can afford it, it might be worth outsourcing. And just like any other chore that either you don't feel like you're great at or you don't want to spend your time doing, pay somebody else to do it for a few hours a week and see what comes of it. It's a non-negotiable. It's critical for us to have clarity around the data. I mean, garbage in, garbage out. We need to know what we're working with. Typically, the first time you do it is going to be the hardest time, and every subsequent, payroll, every subsequent tax year, it gets easier and easier because your maintenance and your hygiene around that is better and more refined. Sometimes what we tell clients is like, pretend you're working out with a personal trainer. Bromley and I both use personal trainers because we know that they'll push us harder than we would naturally push ourselves.
Yeah, I
and
agree.
I know, like, Saturday mornings, I'm not really in the mood to do Pilates, but this woman's gonna push me really hard and I'm not gonna regret it.
Yeah, sometimes
And
set a
it's only
reminder
gonna
and I
take an
just
hour.
check
After
it
an
off,
hour,
right?
I'm gonna feel so much better. So I think that, putting like a time constraint around it, like, try it out for an hour, see how far you get with your budget, with resetting these passwords, with kind of cleaning up this mess. And if you don't make the kind of progress that you want within the hour or 2 hours, then ask for help. And there's certainly help out there. We know so many wonderful bookkeepers who are like fractional CFOs, and they'll hop in and clean up your mess for like 3 hours and make so much progress, and you'll be in an exponentially better spot than you were 3 hours earlier.
Yeah, I can't agree enough on that. A couple kind of points of clarity. So, like, in my financial ecosystem, if I'll be personal for a second, I've got kind of a 3-ring circus going on, maybe a 4-ring. So I've got what's going on with my personal life, right? So how much money am I taking out of the businesses? What am I spending? And so what I try to do is I've got a personal aggregated checking account, personal credit card, and my personal life lives in those two accounts, right? And then I've got our wealth management business, and that's got its own business checking account and business credit card. So all revenue goes in, all cash flow debits coming out are either on the credit card or on that debits out of that checking account or your checks that we write. And so it's at the very least, even if I don't have a monthly run of my numbers like a P&L, I can get it very quickly to you, Alan, because I can just download an annual statement and like, here's a system, here are the flows, and we can catalog them, and it's a bigger project, but at least it's organized, right?
Hallelujah moment for me. You just hand me that financial like that.
Exactly. And then the same thing is going on with my real estate portfolio. My wife and I, we have privately owned 12 real estate properties. There's rents coming in. There's property management and maintenance and mortgages being paid. But again, it's really easy for me to keep my financials straight because it's got its own account. And so the number one thing is just do not, use one card for one thing and sort of cross-pollinate those accounts. It's just not worth it. And then the second thing is beyond just that basic, having a monthly P&L and an analytics for where your business is going is huge, right? On the real estate side, I aggregate it very diligently through a software called Stessa, so I can see what happened with appreciation that month, right? What happened? How much loan pay down did I have? Are there any problems on the 12-month rolling average that I'm not making money anymore? What's going on there? Right? Do I need to, make some capital improvements, right? You can't manage it if you don't measure it. And so all of these things are really crucial for you to have a better product. If your exit strategy is to sell your business for a multiple, like the more you're dialed in on the details, the cost per, sub or the cost per, lead, whatever, the better you're going to be able to sell it. And the more confidence that you're selling a system and not your personal brand and reputation.
So much great information there, Bromley, Elena. And I think it's just going to come down to one word, right? Profitability. Are you making money in your business? Are you sure that you are, right? I know a lot of people like to go online and brag, hey, look at my top line gross. I'm making $3 million a year. But what is your profit? Are you actually making money after you deduct all the costs of advertising, the fact that you made $3 million, all the staff costs that you have to do, all the SaaS costs, all the things that it takes to make that $3 million? At the end of the day, are you bringing in money? If not, then are you really doing any better than when you were just working a 9-to-5 job? Because I know as an entrepreneur, we put in so much more hours, right? Especially on the client serving side too. Sometimes we have to answer client calls at all hours and back to back and all that stuff. But we want to know if all the effort we put in, just like all these content creators out there, all the streaming hours they're putting. I know some crazy streamers are doing like 24-hour streams and things like that. That's a crazy toll and physically and mentally on them. But I'm sure they're willing to do that because they're like, oh, I'm probably making a lot of money to secure a future for me and my family. And I want to hit first person look me in the eye and said, are you sure? Are you sure you bring in the big bucks you think you're making? Right? And they can't answer that. They don't have this accurate record keeping that we keep talking about. And another great point that Bromley made was just the separation of business and personal, right? Just being able to keep business to business, personal to personal, have these separate rings so that how much your business is actually bringing in, how much is on your personal side, so you don't cross wires, right? That makes taxes very complicated. Like anytime people just use like one account for like 3 of their businesses and their personal, they put a cat food, dog food on there, and like, this is not business expense, right? We'd always ask, just make sure, because you're trying to find some crazy loophole that I have never heard of, right? With a dog food account. So I want to make sure, but I have to ask these questions when they mix things. If they just keep things strictly a business, strictly under one entity, like an LLC that's only for this business, make things so much easier. And they know for a fact how much they're expensing each month, right? They can do a rough calculation. The more they commingle, the less clear that picture is, right? And that just makes things a lot harder, right?
And also for that LLC, the easier it would be for an attorney to pierce the corporate veil. And there's just so many parallels.
Other issues, right, with that. Yes, absolutely.
Yeah, Alan, I think to some of your content a month or two ago around fees for agencies and managerial fees, having transparency around what that is and what that cost expenditure is huge, because we see
Yeah, for
those
sure.
rates, the variance of those rates is tremendous. 10%, 30%, 60%. It's huge. So knowing for every dollar you bring in is 60 cents going to this agency, or for every $1 million you bring in is 600,000 going to somebody else.
Yeah, no, and some of these content creators pay crazy agency fees, right? Just to run
Sure.
their marketing, the chat bot and other things like that. And they need to know how much that is affecting their bottom line when they're giving up, maybe half their money away each month to these agencies, right? And another big ankle biter, as I call it, is transaction fees, right? Sometimes international clients, when they're trying to do business with US buyers, they're paying so much more in transaction FX rates, right? Because they don't have a US bank account. They only have an international bank account. So they have to eat it on both ends, right, of the fees. And I'm like, why are you doing this? Why not set up something in the US, have a US bank account, and just go USD to USD, right? Have eat the least amount of fees, because that stuff adds up too. Paying 9% versus 3% is whole 6% of profit you're not making, right?
Yep.
And like you said, and if you look at $1 million business or $10 million business, 6% is a big deal when you look at those big numbers, right? And that's money you can put in back in your pocket if you know that's how much you're paying. And that's sometimes lost in translation if you're staring at a bank account and not really categorizing it well, right? And putting it into it in P&L format, as Bromley has mentioned.
Yeah. Yeah, that's super important, is like what percentage of revenue is going to this expense? And then it's very clear, like, how can, if we want to make a positive impact to the bottom line, we can make more or we can spend less, right? And it's the same with personal finance, right? We
Great
can
point.
make more, we can spend less to get to our savings or profit rate, just depending on that environment we're in. But that's huge, is just looking at like what is the biggest expense that if I made a small marginal improvement would have the biggest impact on my bottom line. Now we can go through it like a CFO and strategically cut or renegotiate contracts and then come out the other end with more profitable business, which again, if your plan is to exit or if your plan is to live off a piece of that, it's not what you make, it's what you keep.
Not what you make, but what you keep. That's that headline right there. We're gonna put in this video. Yeah, so that's a great point. Helena, do you have any more stories, tips to add to this?
No, I think that's just understanding these agency fees and like asking us too. Like we look at all types of statements all the time. Nothing can shock us or really rattle us at this point. So there's no shame in paying more than you think you should be paying, right? It's like, what do we do once we figure out what's going on? How do we fix it? How do we implement a fix? How do we strategize a solution?
Yeah, and you guys have seen it all, right? You guys know what's fair, what's market, and when someone is trying to cheat you out of your money, right? So you get that is something that just worth more than anything that they probably get on that call, right? Just 10-second, 10-minute review of some of your statements. They can save, potentially tens of $1,000s in fees or more, right? Just saying you're overpaying. I know this for a fact because this is double the rate of a normal, right, a transaction of this type, right? So that is so valuable. So, and such a reason why, you guys, listeners out there want to have a trustful wealth advisor that can guide you in the right direction for these kind of situations. All right, now we're moving on to our last but possibly favorite topic, where we want to tell you about some of the financial mistakes to avoid. What stories we have to tell you here is gonna blow your mind and really, really kind of hopefully put you in a path where you're like, I don't want to make these mistakes. And hopefully you're not one of the people out there that's going down one of these paths right now. And hopefully by listening to this part right now, you decide to stop, think for a minute, and perhaps seek some professional help to put you in the right path. So I'm gonna start with one, but you guys feel free to think about your craziest client stories or things that you heard. This is something that I have already expressed Helena Bromley prior to us getting on this episode. But so of course, no names on these calls, but a client has came to me and The only reason that this person even approached me is when they finally did get an angry letter from the IRS. And that is the worst kind of thing, right? That's one of those moments you're like, what am I doing with my life? And they got a letter from the IRS and they're freaking out, scared out of their mind. And they're coming to me. They're like, hey, I got this letter saying I have not paid my tax liability for this many years. They want to look into my file. They might send an agent over. What do I do? I'm like, oh, how did you get in this situation? Well, I listened to a TikTok and the TikTok told me that, all I have to do is just keep avoiding my taxes and it's just going to disappear. And I just stare at her and she just stared at me back. And she was so serious, her eyes. I was like, oh, you're not joking. You're not joking. Oh, okay. Let's start that one. Okay, so first thing first, do not listen to random TikToks that are from unlicensed individuals, right? That is not a good place to start, especially if you're getting, wealth advisory or tax advice. That's something you should stop and, go back to watching fashion or travel advice or something else that's more non-impactful to your financial situation. And secondly, we need to reverse your thinking that you're going to be okay if you keep ignoring your taxes, right? Because this is obviously you can see coming back to bite you. So this person has basically not filed their taxes for 4 to 5 years and are in a lot of hurt possibly with the penalties and interest that's been accumulating and adding up. And they're in a situation where they haven't done a lot of good record keeping. They can't remember very well about how much income they're bringing in. A lot of statements are missing. A lot of expenses that would, we're trying to help them, record and count. They don't know if it exists or not. I'm like, yeah, we need to go back and jot your memories because we don't want you to pay more than you have. And it's a very dangerous situation when you're 4 to 5 years, into this mess. And what I'm trying to say is don't be this person. If you're out there listening and you maybe have watched this very popular TikTok apparently, which have gotten hundreds of thousands of views, stop, right? Don't stop listening to it. You cannot just ignore your tax situation. You're just going to disappear. I think the video also mentioned you can try to escape to a different country and hope they don't come after you and things like that. Also a very dangerous thing to do. So please don't do that also. And just really examine it and really find a way to climb out of it. Another thing that I would want to caution you guys is, clients who have done this also have a lot of trouble securing loans, getting a house, right? Things where they want to see your tax returns and see what kind of situation you're in. If you haven't filed in this many years, it's gonna be very hard when even if you do make a lot of money to secure a house for your family, get a car, get a loan, get into situations, possibly sign with certain vendors if they want to do a background credit check on you. So don't be in those situations. If you want to make sure that as you're making money and doing well in your business, file your taxes, get that done as soon as possible. If you have to catch up, find a professional that's expert and specialized in this stuff and get yourself caught up. So you don't have this sleep at night worry about this stuff that someone's going to come knocking your door or you get those angry letters from the IRS. Kind of crazy, right? That it doesn't happen to go
this
fight all the time.
And I thought of a couple of things as you were talking through that story, Alan. So one is, for the 1099 small business owner, we should be escrowing a certain amount of income or profit on a monthly basis to be going towards our quarterly draws. Right, or we're actually, and probably most of us aren't doing that. So at least escrow it in a separate holding or earmarked account so that come tax time, like that money is available. If you make a ton of money and you don't, there's the 4-letter word that's not 4 letters, budget for it, it's painful. But if we plan ahead, it's no big deal, right?
For sure.
And then the other
these guys don't do that.
the problem with really any kind of TikTok advice, and we really try to tell through context stories, a recommendation given a certain sort of avatar, because at the end of the day, there's a lot of things that aren't universally right or wrong. The world is a lot more nuanced, and you have to understand that there's no such thing as just one way for financial success, one way for tax success. It's about the facts, right? What kind of business entity, how you're making your money, what your goals are, right? Like, what kind of, pre-planned tax strategies you have, right? There's, what was the family dynamic? So if an advisor is not taking into account your personal situation and they're understanding the facts and where you're trying to go, then they're not giving advice, right? So you have to understand that it's got to pass the suitability sniff test for you even to think if I should, give any weight to this. Does this person know my situation? Do they know what I'm trying to achieve? Do they know my time horizons? Do they know my risk tolerance, right? In our world,
Yeah.
that's all circumstantial to how we're going to develop and deliver a plan that's custom made for you to be successful, right? And so just think about that, right?
Right.
Most
Absolutely.
people on TikTok are trying to get extra likes and follows and subscribers, right? And so a lot of them will say things that just get a reaction or a rise out of you, and it's not really advice, and it's illegal, right? Or it's not well thought out, or it's not suitable for you and your situation. So
Yeah.
just
And then sometimes you can't read a tone. Maybe they're just joking about, right, a certain thing that you should be doing. And if you read it wrong, you're gonna, oh, this is real, right? And then you kind of take it and try to apply it to your life. But you got to remember, like Bromley mentioned, it's very general, right? It does not always apply to a specific situation, a specific income level, your specific risk management that you need to do for yourself. So you can get a lot of trouble doing that.
Glenn, have you got your story ready?
My story. So yeah, I mean this is getting kind of deep, but I think that one really critical takeaway that our clients appreciate about our firm and working with us is that we always encourage people to be respected instead of being liked. And we see this play out financially in so many different ways. There's a lot of buzz around private equity, co-investing. We see a lot of people who want to like be the martyr and loan their cousin $100,000 because their cousin is starting this multifamily syndicate, and it's like, how many multifamily syndicates has your cousin run before? Oh, well, this is his first. It's like, well, if there was another person, another investor who was asking you to be a limited partner, but had a zero track record, would you invest 100K? Well, no, but it's my cousin, right? So I think that just the psychological implications of creating wealth, of seeing yourself as wealthy, ultra wealthy, sometimes repel people into really wanting to be liked for their balance sheet and for their ability to invest and help grow somebody else's wealth. Sometimes it's a good move, not always. And it's it's a common mistake that we see that people want to utilize their wealth kind of for ego. There's really no other way to say it. And it's not that we're necessarily against it, but it's like categorizing that as Vegas money, gambling money, donation, right? Like that's an incredibly speculative investment in creating your own private placement deals.
Very, very good point. And I love the family fallacy or pitfall that you mentioned, Helena, about how, this is my cousin or my uncle, I love him, he can't steer me the wrong way, but he has no experience in the world that he's entering in, right? Like he's starting a fitness brand. He's like, I don't think he's done a day of exercise in his life, but no, he got this. Let me put 100K in his business, right? Like it just doesn't logically make sense sometimes of
But
what
emotionally, it feels
yeah,
right. Of course, you want
but
to.
emotionally you're like, I'm supporting my family, he's gonna do right by me. But you guys gotta understand, even when investors do this, right? They're knowing the fact that their 100K can be zero at any point, right? They're taking that risk, but it's a calculated risk because they've done the math, they've done the research, they have models that track this stuff. But for you, it's like they're like, hey, so on TikTok, 5 other fitness fans doing eight figures, I'm gonna be the ninth, right? So they just go in for it, right? But that's not how the way it works sometimes.
Yeah, and along that same vein, be very careful of just blindly going with somebody else's brilliant investment idea, especially on this like private equity kind of kick. I've seen a lot of people that assumed, like, let's say Alan brings up this cool deal, he put some money in. Well, Alan's a pretty savvy business guy. He probably vetted these people, did the background checks, checked the deal out, right? Like, evaluated the risk. So I'm just going to throw my money in because I assume he did, but I don't actually fact check that, right? And
Yeah.
I've seen specifically for so content creators in the real estate world, a number of really large ones, millions of subscribers. They're making tons of money. All got caught up in this basically machine learning, Forex trading, algorithm based performance, which
Like the bot trading stuff. Yeah.
Ponzi scheme, right? So, do your own due diligence and don't. And if the returns seem too good to be true, just like your mama told you, it's too good to be true.
Or even if she didn't, we'll tell you.
Mama Helena will tell you.
Mama Helena will tell you.
Yeah.
But yeah, as far as mine, I'm just going to keep it very simple. I think the biggest thing is as we start getting success, we want to be cognizant of lifestyle creep, right? Because, Helena and I have high-powered attorneys and doctors and, just business owners that kick off a ton of revenue, but as fast or faster, they inflated their lifestyle and they bought, their dream home with a pretty big mortgage, and they bought a second home with a pretty big mortgage, and they bought their dream car with a car payment. And
that's a lot of payments.
And what ends up happening is some of those assets could go up, could go down. They're definitely not putting money in your pocket. They're taking money out of your pocket. And we're just creating this rat race, or, slowly putting ourselves in the chains of debt servitude. So be very careful of that. In general, buy assets that pay you to hold them so that your assets can buy your liabilities. That's the safest way to do it. A la Rich Dad, Poor Dad, Robert Kiyosaki. So that's one. And then a really simple story, and this is more, again, on the debt side. Helena and I had a client who was kind of on the beginning of her financial journey, not the end, right? But she had some credit cards and she was running the balance. And we're evaluating the statements, and we noticed she had spent like $3 or $4 grand in interest. And
interest. Oh wow.
Interest, 3 or 4 grand in interest.
Whew.
And what we realized is, well, she's like, well, I just, I like Air Force Ones, and I want to go buy them when I see them. And we're like, all right, well, if you like them, just understand, like, if you bought the company here, right? Call it Visa. I don't know if it was Visa, American Express. No harm against any of them, but you bought them many Air Force Ones. So if you want more Air Force Ones in your life, let's get out of like borrowing from our future earning potential to finance them. Let's slow things down, and when we can pay cash for them, we can buy them, right? But again, debt can really be a noose around your neck, so don't let it get its grip.
That is such a common theme, Bromley, of this overspending. I have seen it a lot on the tax accounting side too. I had a client that was making fairly decent, really money, right? Like he was making, I would say, mid 6 figures, so he's doing quite well for himself. But when I put together his books for him, I noticed that he's literally not making any money at bottom line. I was like, what's going on? What's happening with all your cash? And also you have a couple of loans outstanding here too. Like how can someone who has made like, mid 6 figure be in this kind of situation? And what he explained to me was, he said, I was taught that I should try to break even every year. I should try to use up all my money, right? So he went out and buy like iPhones and MacBooks for all his friends and employees and family. He went and bought Teslas for him and his trusted like partners and colleagues. And he just spent so much on these depreciating assets out there, right? And I'm like, if you have used this money to buy maybe even just Apple stock or Tesla stock, from like, this is like 5-6 years ago, right? Like you'll be banking right now on all this like passive income that you might be bringing in right now, just on the dividend reinvestment side, right? And I'm just like,
Alan.
Yeah, it's just insane, right? Like this person's doing this, and I'm like, how can a person who's doing so well but does so little at the bottom line like get? And he also believed that basically like everything he spent, he was gonna get 100% of the money back from the government. Right? He thinks like everything is a 100% write-off, but in his mind, 100% write-off means, if he spends 2K, he gets 2K back, right? He doesn't understand the marginal tax part of it, where it really only counts for, say 28%, right? Because that's the bracket you're in, right? But he sees it because he, probably watched some TikTok saying, "Hey, just keep getting these write-off, 100%." And that's what that they interpret it as. You get 100% of that money back in your pocket.
But
you guys out there, that's not how it works. You guys do not
how it
get
works.
100% of your money back for taking business write-off. Please do not start buying random things.
Yeah, it's the old don't let the tax tail wave the tax dog or the I blew that one, but what I was gonna say is like in the same note, right? Is the good thing about being a business owner is we earn our money, we spend it, and then we get taxed. Versus a W-2 is we earn our money, it gets taxed, and then we get to spend what's left over. So it is more efficient. But to your point, understand that if you buy something for $1, right, your write-off might be 30 cents. So if you didn't need to spend it, you just lost 70 cents. Like that's not a way to get wealthy.
Yeah, you guys see it as
right. That's a bad trade-off.
Not as a full. This thing is free now. Way of thinking.
Exactly. And then I think more important to that though is if we don't have a profitable business, and we see this a lot, is what's one of the big financial goals many people have? Well, it's to buy and qualify for a house. Well, if we don't have the income to show, then from a debt to income ratio, we're not qualifying, right? And so, you also want to, maybe you want to take out a business loan in the future. Well, what are we going to secure against? Like your business doesn't make money, right? So you want to make yourself look more attractive. So there is a balance between paying taxes and then avoiding taxes, because there are some benefits, and you just got to understand what season your business you're in. Are we trying to maximize profitability, or are we trying to maximize tax deductions, right?
Yeah, and they're just better things and assets to put your money in, right? At times, even if you do have that excess cash that you're trying to spread out, right? Like we talked about at the beginning of this episode. That's why those retirement vehicles are so strong. It's where you can park some of that available cash, but at the same time, that money's not going away. In fact, it's growing on your behalf, right? And even if that's something where you're trying to retire earlier and not looking for that 59.5 target, worst comes to worst, you put it in a brokerage and spread it out in some mutual funds and index funds, and that can be more diversified than buying iPhones and MacBooks and random cars and having them depreciate in front of your eyes, right? iPhone 15 just came out, so my iPhone 12 is not worth as much anymore. Yeah, it's number 15, right? There's a money generating machine over there at Apple. That's why Apple is in my opinion, it's a pretty good deal, right? Because people just keep buying them up every year.
Yeah, my phone, I'm sure, is going to be set to self-destruct then in a few minutes.
Oh yes, that is always the myth, right? That some Apple engineer is just saying, okay, everyone who has a 11, okay, you guys are gone, right? Because they're forced you to buy the next generation phone, right? So
I thought they got into a lawsuit over that. I think
they some kind of slowdown they put in the phone or something. Like the phone just started magically slowing down around the launch of a new iPhone, right? Yeah, I think it might be true then, huh?
I don't think it's anecdotal.
Right, it might be true. Yeah, unfortunate.
At the same point, if your phone's working and it's got good life, like you don't have to run out to buy the newest one. But nothing against it if you can afford it.
Nothing against it, but just remember it's not 100% write-off. I think it was a TikTok like this, and I really think it was a joke, because they were like, I'm gonna buy this bench. It's fine, 100% write-off. Let me buy 3 of these computers, 100% write-off. It just goes on and on about it's okay to buy all these things for your business. But I think some people by watching it saying, oh, it's telling me I need to go buy all these things because I'm gonna get all this money back in a tax refund form, right? But guys, that was just a skit, a very funny skit at that, but it doesn't mean you get 100% money back. And sometimes I think people just don't finish watching the videos. At the end, they tell you it's a joke, but then they just watch like half of it and they're like, oh, I understand this video. I understand the point now, Finish watching the video. At the end, you'll have a disclaimer. Well, they should. They're trying to be a responsible content creator. Great. Hey guys, thank you so much for joining me on this episode, Bromley and Helena. I think it was super insightful and super powerful, some of the advice we're able to give our listeners out there. Hopefully you guys enjoyed it. If you guys have any questions or comments, feel free to leave us a like and a comment below, and we'll try to get back to you. And if there's any specific areas that you're looking for, on the wealth management side, I'm gonna get Bromley and Helena to leave their contact and a call link down there along with the socials, so you can reach out to them directly. and talk about a specific situation. They will love to help you and give you the best advice possible for what you're going through for your business. So thank you guys again for joining me on this call. Appreciate it.
Our pleasure.
Thanks for having us.
Have a good day.